Welcome back to Intro to Financial Services Industry. This video is on equity products, part one. The reason why I had to break up equity products into several different parts is that there's just so much to talk about. So with that, let's get going here. Same disclaimer I always say, this presentation is geared towards a novice. If you're an expert and you really want to know this stuff, go look for other sources. I would recommend the book After the Trade is Made. And also, we're not going to be making any, we're not going to be offering any financial advice on or guidance on personal investing or strategies. That's not what these videos are about. So let's start talking about equity products. Equities are an instrument that signifies a ownership position in a corporation, right? And that's why they're called equities, right? An equity is a security that represents a claim on a proportional share of the corporate assets and profits. So when we talk about equities, what someone is doing is they're buying stock, and each share of that stock is a proportional claim against the assets and profits of the corporation, right? Ownership of the company is determined by the number of shares a person owns divided by the total number of shares outstanding, right? So equities are proportional ownership in corporations, and therefore it gives you a claim to the assets and the profits of the corporation. For example, if a company has 1,000 shares of stock outstanding and one person owns 50 shares of the stock, then he or she would own 5% of the company. Most stocks also provide, common stocks will also provide voting rights, which gives a shareholder a proportional vote on certain corporate decisions. So when you buy common stock, when you buy equity shares, you're buying that proportion of the ownership of the firm, the company, and you're also buying, if it's a voting shares, and not all shares are voting, but if they're voting shares, you're buying votes proportional to your ownership, right? And that's really important, because what you'll find is there are some type of stocks, some type of equities that don't have voting rights, but they have other qualifications, other factors. Now, that's what equities are. You'll often hear the term used, and actually it's not used as much as it used to be, of blue chip stocks. And I don't know, I think the term blue chip, I think, goes back to the old days of people playing poker, and the blue chips were the most expensive chips, right? Like the white chips were the cheapest, and the red chips were like, $5 or whatever, and the blue chips were the most expensive. So blue chip stocks are large, well-established corporations, and usually they're companies that can be depended on to pay a dividend. So an investor that wants to buy stock in a large, well-established, low-risk, dividend-paying company, those stocks are sometimes called blue chips. High, well-capitalized, well-established companies. And that's blue chips. Now, dividend payments are not all blue chips are going to pay dividends, but often blue chips do pay dividends, right? Or that they have a history of paying dividends. And again, this term blue chip goes back to the days of poker chips, where the blue chips were the most expensive chips. Okay, so equities are stocks. When we talk about equities, we talk about shares. We're talking about shares that represent ownership of the company. So in theory, if a company has $1 million in assets and you have 5% of the stock, you would be an owner of 5%, or you would have a claim to ownership of 5% of those assets. Now, if the company went out of business and they were to liquidate, they would have to settle any debts with outstanding debts. So it doesn't necessarily mean that you own 5% of $1 million in assets. It's the assets after all liabilities are paid off. But that's the concept. So think of it as owning 5% of the company. Okay, now, what did companies do, or what do companies do today before they issue stocks, right? So let's talk about a company. Let's just say that you create a company, and your company is a lemonade sales, I don't know, anything. So when you first start your company, you put your own money into it, right? Maybe your company it's a little store that sells lemonade, and you're going to take your own personal money, and you're going to put it into opening your store, buying the lemons, buying the glasses, renting the storefront, and doing everything you need to do, buying the refrigerators or whatever. And it's your money. You put your money into it. It's your business. You own it. Well, let's say it grows and grows and grows. You find that lemonade, you can freeze it. And if you're freezing, you can sell this lemon ice. You can do more things with it. So maybe you bring in partners. Let's say you bring in two partners, and each of them, you give them 25% of your company, right? And maybe one of them is able to contribute. He owns a freezer and can freeze lemonade and sell this lemon ice. And somebody else, your other partner, has expertise in marketing, and so therefore you give him the 25% of the company, but you still own 50%. So you started with personal funds, and then you brought in partners, and they either brought assets or they brought skills, or maybe they brought cash. But now you have partners. So you own the company with your partners. Then what happens? Well, then you say, look, you realize that if you open a second store down by in the theater district, or you open a second store that's down by a university or something, or a playground, that you can sell more of this lemon ice. So what you do is you go out to your mom and your dad and you borrow money, and you borrow money from relatives or whoever, and you use that to hire employees and rent the other store and buy the equipment. So you grow and you grow and you grow. Now you're starting to be more successful. You want to open a chain of stores next to all the playgrounds in your city to sell your lemonade and lemon ice. So what you can do is you're going to go out and find private investors. Now you're still a private company, but you go to these private investors and you're going to get money from them. You're going to get investments that they're either going to take back as debt, or maybe they're going to take back as a portion ownership of the company. Maybe you've got somebody who will lend you $100,000, but for that, they wanted you to enter an agreement that they own 20% of your company, or 20% of profits, or some sort of agreement, right? So now you've grown your company. You're still a privately held company. Now you come in, you guys have venture capitalists come along. Venture capitalists come along and they say, hey, look, which are also private investors, but they're a little bit larger scale. The venture capitalist says, I want to give you money so that we can open stores across all the state, next to all the playgrounds, and we're also going to give you money that you're going to use to lease trucks, and with those trucks you're going to drive around and sell lemon ice, and also you're going to sell ice cream out of the trucks to local playgrounds. So the venture capitalists give you this money to greatly expand your business. So now you're going to take more money in and you're going to expand your business. But the venture capitalists, they want something in return. They want to have what's called a liquidity event, or they want to have something, they want some way of getting their money back. Venture capitalist is willing to put money into your company for portional ownership, but they only really want to be in your company for a couple of years. Venture capitalists want to come in, they want to invest in your business, but they're only interested in your business They're not interested in getting a return on their investment every quarter for the next 50 years. They want to come in and they want to turn a big profit, and at some point sell out their share of your company, right? In order to do that, they need a liquidity event, like the sale of your company to a larger company, or maybe issuing a stock and going public. Okay, all of these funding options rely on some debt obligation or ownership stake in the company. So everybody, each of these things, whether it's your own personal funds or your partnerships, or you're borrowing money from your mom and dad and your relatives, or it's working at private investors, or it's venture capitalists, in each case, either you end up with a debt to someone, or you trade off a ownership stake, a percentage ownership of the company to someone. That's what's happened. Now, why do companies issue stock? Well, what happens is companies get to the point where they've gotten to this point, they've grown, and now they want to get more funding. They need more funding to grow, and they need more funding to pay off debt obligations, right? So they need to raise more capital for the company. Maybe they need to buy more trucks, and maybe they need to buy warehouses, and freezers, and equipment. Also, those venture capitalists, they want to sell their stake in the company, and in order for them to sell off they want to turn their debt obligation or their percentage of ownership in the firm. They want to turn that into something that's liquid, something they can sell. They can get cash. So early investors may want to get cash. They may want to get rid of their ownership, get a cash return, and by giving them stock, by them turning their proportional ownership into stock that can be sold liquid on a market, gives them that capability. Okay, so what do companies do when they've grown to the point where they're ready to go public? So first thing I want to make sure you understand is companies can have stock and not be public. You can organize your corporation so that you have shares of stock in the company, but you're not public. And if something's not, the problem is if you're not publicly traded, that stock's not necessarily liquid, right? I mean, it's very hard for someone to sell it, right? So companies grow to the point, they say, okay, we want to now go public. We want to do an IPO, initial public offering, right? So they're going to go to an investment bank, and they're going to get an investment bank that's going to help them roll out an initial public offering. That's going to raise money. So the company's going to issue stock. The company's going to say, okay, the company has so many shares of stock. Let's just say the company has 400,000 shares of stock. The company's going to retain 300,000, and it's going to sell to the open market 100,000. So that means that a quarter of the ownership of the company is being put up for sale. So 100,000 shares outstanding are going to be offered. So investment bankers work with companies to create these IPOs and to work with the regulators to make sure that everything is legitimate and that everything fits the qualifications and regulations required to have an initial public offering. And there's a system the SEC has called EDGAR, EDGAR. You can go online and you can get public information about companies that are looking to go to have an initial public offering. Because now, instead of borrowing money from your neighbors and your parents and dealing with venture capitalists, now you're going to be offering shares to the public, to the general public. So now the regulators have to come in and make sure that everything is above board, legitimate, and it's all fair playing field, and there's no scam going on. Now, the regulators approve this, and you now do an IPO. All right, now the first thing I want to put this is the first time I put anything on these presentations in red. Results may vary. People sometimes think, oh my goodness, I want to get in on the IPO. That stock, it opened on the morning of the IPO, it opened at $2 a share. And by the end of the day, it was selling for $20 a share. That's true, that does happen. Sometimes there is meteoric rises. But there are also stocks the pre-IPO, they had an expected price of whatever. And when the IPO actually got issued, the price declined. It wasn't at that price. So if you had a pre-IPO estimate that your stock was going to sell, let's say you thought it was going to sell, the pre-IPO estimate was $5 a share, and then the morning of the IPO, you find that by mid-morning, by the stock is selling for $1 a share. Results may vary. I guess my point here is, yes, there's a lot of money made on IPOs, but not always. Results may vary. What you need to do is talk to an advisor, talk to a financial professional. Don't just go out and buy IPOs. Talk to a professional, talk to an advisor. That would be my suggestion. That's not advice. I'm not giving any financial advice here. I'm just making a suggestion. This is also why you'll see that people at brokerage firms are often barred, employees of brokerage firms are often barred from taking up positions on day one of any IPOs, because they want to make sure that it isn't being manipulated. There's nothing fishy going on. I don't know if any of you watch the show Mad Men, which is a great television show. There's a lot of actually good information in there about investments. But if you guys remember, in season 6, the character Joan, the redheaded lady in the green dress, was really angry at the character Don Draper, the John Hamm character sitting down on the right. So why was Joan so mad at Don Draper at the end of season 6? The reason is that they were going to take their company, their advertising company was going to go public. And Joan was a partner in the company. So therefore, as a partner, she had a 5% stake of ownership in the company. And if the company went public and the stock was sold in the market, she was going to become a millionaire. But Don decided not to do that. And instead, they merged with another company. So in the merger, so they stayed a private company, they merged with another company. And although they ended up being a larger company, Joan's share, she was a partner in a bigger company, but effectively owned a smaller share. So what Joan wanted is she wanted a liquidity event. She didn't want to be a owner. She didn't want to be a 5% owner of their company, and she didn't want to be a 2.5% owner of a larger company that merged. She wanted to have a liquidity event where her 5% ownership translated into stocks that she could sell in the market, or she could take loans against on the market, and she could take a profit and be a millionaire. And then you'll see the character on the far right, Peggy. She was kind of ticked off in that season because she wasn't a partner. So no matter what she did, she wasn't making any money. So why do some companies choose to remain private and don't issue stock and don't become publicly traded? The first reason is some companies don't want to go public because they want to maintain private control and management, or they want to keep their financial records private, or as much as private as possible. When you become a publicly traded company, all of a sudden, all your financials and all your internal operations, all your internal information, you're publicly traded. So therefore, all that information is publicly available. You can't keep your secrets. You can't be doing the behind the curtain deals, and you have to publicly disclose all your financials and other information. Also, another reason was sometimes companies don't see any compelling case for going public. They like being private. Now, I'll give you an example here. I'll give you an example of Tabasco. Most of you have probably gone to a place and seen Tabasco sauce. And I thought it was interesting. I saw this on 60 Minutes. There's only one company in the world that makes Tabasco company. And they They make all the Tabasco, right? To use the name Tabasco is that one company, and they're privately held. And what it is the company goes back to their great grandfather or whoever started the company, and the children and grandchildren and great grandchildren of the original founders all own a stake in the family business. They have a proportional ownership of a privately held company. They own their share, their proportional share, that's been divided up through the generations for the grandfather to the great grandchildren, great grandchildren, and they own it, and it's a private company, and the family manages it. So they don't have to tell people how much money they're making, or how much money they owe, or they don't have to share any of that information, and they just manage it themselves as a private company. So for them, going public, unless they needed capital, there's no compelling case for them to go public. I could give you other examples. The best one would be in the securities world is, we talk about Merrill Lynch, and we talk about Charles Schwab, and we talk about Toronto Dominion. But one interesting thing about Fidelity Investments, which, by the way, is one of the absolute best companies in the world and one of the best companies in the financial services industry. Fidelity Investments is privately owned. It's owned by the Johnson family, right? So, or a trust of the Johnson family, or the members of the Johnson family, but I don't know which, but it's privately held. So as a result, that company, because it's private, can do things very quickly, and they can do whatever they think is right. And they don't have to they don't have to worry about what's going to be what does Wall Street think of our earnings next quarter. They can plan long term. They can take a strategic vision. So maintaining private ownership and not issuing stock that's traded publicly can be very advantageous. Now, it has the downside of it is stock is a great way to raise capital. But if you don't need it, companies sometimes will choose not to become publicly traded. That's the point I'm trying to make here. I hope that's helpful. But when companies do become public, they issue shares of stock. Now, this is an example. This happens to be a share certificate. I think you remember I talked in the earlier presentation about how today we don't issue certificates, but this is an example of an actual certificate. And it's dated from, I guess it was turned in 1903, December 30th, 1903. And it's for a railroad company. And in the 19th century, railroad stocks were, there were a lot of railroad stocks, and they were highly speculative, right? But this is actually an interesting example. I like the certificate because it tells you that the bearer of the certificate, I can't see, it's Mr. Goldsmith Wolf and Company, I guess. This certifies that Goldsmith Wolf and Company owned 10 shares of stock in the Baltimore and Ohio Railroad Company. So I don't know how many shares were outstanding, but this company owned 10 shares in that company. And it was common stock. It tells you right on the face that it was common stock. So presumably common stock, it would have voting rights. So common stock, common shares, again, it's a security that represents ownership of the corporation. The holder of common stock exercises control by electing board of directors and voting on corporate policy. So when you own common stock, the shareholders elect, based upon how many shares they control, is proportional to their voting rights. The shareholders vote, and they elect the board of directors. So people talk about the chairman of the board, right? The chairman of the board is the chairman of the board of directors. What does the board of directors do in a publicly traded company? The board of directors oversees the interest of the shareholders and hires the management of the company. So the CEO, the chief operating officer, the chief financial officer, all of the layers of management of the company are hired by the board of directors. So the power of the board of directors is to control corporate policy, represent the the shareholders' interest in the company and represent the policies and practices of the shareholders of the company, and to hire and oversee the management. So the management of the company, the senior management, the CEO, the president, they are responsible to the board of directors. Board of directors supervise them as the ones who have the interest of the shareholders at stake. Common stockholders are at the bottom of the priority list of ownership structure, right? In the event of a liquidation, common stockholders have the right to the company's assets, but only after bondholders, preferred shareholders, and other debt holders have been paid. So as I mentioned earlier, let's say you own 5% of the company and the company had $1 million in assets. That doesn't mean that you have a claim on 5% of $1 million in assets. You have a claim on 5% of the firm's assets, but only after the bondholders, the preferred shareholders, and anyone with legitimate debt claims have all been paid. After all the debts have been paid and the preferred shareholders and the bondholders have been paid, then the common stockholders get paid. That's how it works. Now, because the common stockholders will typically, or in this case, will have in most cases, or in many cases, or in some cases, have voting rights and they elect the board of directors. What are some interesting things the board of directors do? Well, the board of directors actually control what's called corporate actions. So, for instance, if the company declares a dividend, that dividend is approved by, voted on, and can't go out unless it's approved by the board of directors. So the board of directors are the ones who are going to decide, are we going to do a dividend? Now just think about this. Let's say you've got two groups on the board, and one group says, we've got $1 million of profit at the end of the year, and we want to declare a dividend and pay each shareholder 10 cents or whatever. And then somebody else at the board says, I don't want to pay 10 cents to every shareholder. I want to take that $1 million and I want to buy this small company that's a potential competitor, or I want to take that $1 million and I want to use it to develop new products, or I want to take that $1 million and I want to buy new real estate that we can build our corporate headquarters on, or I want to take that $1 million and somehow reinvest in the company. So this is where the board of directors representing the interests of the shareholders can be in conflict, because they need to decide, are we going to pay a dividend to the common stockholders, or are we going to reinvest in the company? So obviously the voice of the shareholders becomes very significant, and it often has different views depending upon who your shareholders are. By the way, in the United Kingdom, common stock is called ordinary shares. Okay, because I can only have these sessions be so long, that's part one of equities. Again, I'm Paul Judge. Here's my email. Please send me any questions and I'll do my best to answer you. Thank you, and I hope you tune in for part two of equities.